happy and honored to introduce today's seminar, which is restarting our webinar activity of the year and our scientific webinar activity of the year. And the topic of today's webinar is the challenges, in plural, of estimating insurance assets and liabilities and the relevant discount rate. Therefore, we will discuss the relevant discount rate and moreover, the question of the risk-free discount rate in relation to the risk adjusted discount rate. This webinar will be hosted by Christian Gaulier, who is currently Professor of Economics at the Toulouse School of Economics, of which he has been the executive director. Christian Gaulier is the lead author of the fourth and fifth reports of the Intergovernmental Panel on Climate Change, a former president of the European Association of Environment and Resource Economists, and a winner of the Paul Samuelson Award. He is one of the leading world economists on the economics of risk, finance, and climate change. Of course, you see the relation between the three topics, which are very tight. Today, he will investigate how much the conjunction of the changing monetary policy, what I have in mind is the quantitative easing. We know that at this point in time, the quantitative tightening has not fully resolved the former quantitative easing. Secondly, the increased share of public debt in central bank assets, which is something new. The increased debtor position of commercial banks vis-à-vis central banks, and the expanding public debts around the world are making more difficult the practical estimates of the discount rate and especially of the risk-free interest rates, which are, of course, at the basis of all our calculations concerning the valuing of risky assets and liabilities. Of course, it is weakening or even the current situation, the current monetary policies, the current public debt increase, the current debtor position of commercial banks with regard to the central banks are weakening or even undermining the reference to the sovereign interest rates as a first rough approximation of the risk-free interest rate. And as you know, most regulators around the world are suggesting, sometimes even imposing, this reference to sovereign interest rates as the main risk-free interest rates, as the reference risk-free interest rate. But if these sovereign interest rates are no more risk-free, you see immediately what may be the problem. Christian Gaulier will present an in-depth discussion of this point. Let me stop there because you are here not to hear me, to listen to me, but to listen to Christian. And no, Christian, you have the floor. Just before that, let me remind you that question will be asked after the presentation of Christian Gaulier, except if there is an understanding, technical question of understanding an argument or something which is not clear, or even which has been confused because of a break in the transmission. But otherwise, of course, all questions will be raised after the presentation. Christian, you are now how much time you want and you need in between 45, 1 hour. It depends from you. And thereafter will be the Q&A session. And in any case, we will stop at 3:30 p.m. Paris time. That is in 1 hour and 30 minutes. Okay.
In 20 minutes. Okay, thank you very much.
Exactly.
Thank you very much, Philippe, and thank you for the introduction and the nice words. Yeah, I would like to talk about in particular valuation of long-term assets and liabilities. I will not specifically talk about assets and liabilities. I will talk in general about how do we value uncertain future payoff, and I will do it from the point of view of a representative economic agent. Could be a citizen, a consumer, or a firm, or a bank, or an insurance company. Let me share my screen. Okay, do you see my front page here?
Yes.
Okay, perfect. Okay, so you know, as Philippe explained in the introduction, I'm a decision theorist under uncertainty, and after doing insurance economics in the 90s, I moved to asset pricing, and then I moved to long-term asset pricing, and then I moved to social cost of carbon, and then I moved to climate change economics. So climate change is I think a good example of the difficulty we face, you as an expert in the financial sector, and me and us in academia, to put a value on something, on the flow of benefits or cost that lasts for a very long time horizon. So, as you know, when we emit 1 ton of CO2 today, this ton of CO2 will be there for a very long time. I mean, not only decades, but even centuries. And some climatologists believe that they are there forever, almost forever, at least compared to the typical time duration we explore in economics and finance. Those maturities are counted in centuries. To show you, to give you the feeling of the potential disagreement we face about how to value those things, let me take the example of this social cost of carbon. So remember, social cost of carbon is the present value of the flow of damages generated by emitting 1 ton of CO2 today. And in the early 2000s in the US, that net present value, this present value was estimated to be around $50 per ton of CO2 at the time when the committee of experts under the Obama's administration used a discount rate of 3%. And then the occasion of the first mandate in the White House by Donald Trump, this discount rate has been increased to 7%, and as a consequence also, Trump decided that only damages borne by Americans should be counted, not damages borne by other people in other countries of the world. So the consequence of that is that the social cost of carbon was being re-estimated to not 52, but $1 per ton of CO2, meaning we should not do anything to fight climate change. And then Biden came back in 2021, as you know. The Democrats came back with Biden, and they re-established the discount rate of 3%. It re-established the social cost of carbon at $52 per ton of CO2. And eventually, just before, it was December 2023, so 1 year before the end of the Biden administration, the US decided to reduce the discount rate they use to evaluate public policy, in particular climate change. They reduce it to 2%. And by reducing the discount rate from 3% to 2%, that move the social cost of carbon, the carbon value, if you prefer, to $190 per ton of CO2. They do not only use a discount rate of 2%, which would be the risk-free discount rate, they also integrate it into the model risk adjustment. And as we will see, this risk adjustment plays a very important role in the increase in the social cost of carbon. So my talk today will be focused on as you have seen here, I mean, the whole of the discount rate is very important. A small change in the discount rate increase dramatically the present value of cash flows with very long duration. All actuaries know that perfectly well. And so it's very important to have a discussion about what's the ultimate forward rate, as if I use your vocabulary in Europe among the actuarial science community. So why did we increase we the economists, we dramatically increased this carbon value of the last few years? Not only we reduced the quote-unquote risk-free rate to 2%, and why did we reduce the risk-free discount rate? I will come back on that question in a minute. That will be a central element in my presentation. So we decided to use a much smaller discount rate and therefore having a much larger social cost of carbon. But also we need to take into account of the fact that the future is very uncertain, and this macro uncertainty would imply that for the standard savers and investors, the fact that the future become uncertain imply that you should save more and invest more in risk-free assets in order to be better able to face that future uncertainty. And therefore, that should reduce the discount rate. I mean, we should put a larger value to project which generate a sure income, a sure payoff in distant future where the uncertainty about what will be average consumption at that time. So that's a concept of precautionary savings or prudence. I will come back on that too quite quickly, in fact. And that's probably the most important for an insurer. We should also take into account of the fact that we are risk averse. We are risk averse, and the risk aversion, this risk aversion should imply that we should particularly favor action today that generate an indemnity, a payoff that would materialize in the worst state of nature. When we go back to Stone Age at the limit, okay? When we go back to, there is a small probability that civilization will go back to Stone Age, and in that case, taking action today that specifically target those very unlikely scenario and generate a positive income in those scenarios should be particularly valuable because of risk aversion, because of the marginal utility of consumption is very large in those states, and therefore we value a lot this insurance contract. So and of course there are a lot of actions that are negatively correlated, whose payoff are negatively correlated with consumption. Okay, an insurance contract is exactly that. An insurance contract is the contract where you get something more if your consumption is low. So a negative correlation between the payoff of the contract and your consumption. And if we have a preference for that kind of contract, we are ready to pay a premium that is larger, maybe much larger than the expected indemnity, but still, because we are risk averse, we like a lot this insurance contract because it generates a way to hedge this risk of a very low consumption exposed. Okay, so there are a lot of assets that generate that kind of insurance policy. Let me take just an example. Having a large capacity to produce vaccine against a specific pandemic The cost may be quite large to store those vaccines. The expected benefits may be smaller than the cost of having the storage of vaccine, but because this mechanism generates a lot of social benefits in the case of a pandemic and maybe a worldwide pandemic, this policy may be socially desirable. So this negative correlation between the macroeconomic consumption level and the payoff your investment, your action generate is a key component. That's the idea of an insurance contract. Okay, so my presentation here will be particularly focused on two things. First, why do we discount the future? And second, how do we adapt this risk-free discount rate to the case of valuing risky action whose outcome are uncertain. And of course, as you see, the important element here will be the positive or negative correlation of the payoff to a change in aggregate consumption. And this is all these debates is related to this notion of sustainability. And at the end of the day, my own interpretation of this problem of sustainability, which is becoming a very important social concept that is really debated in our countries. This sustainability is precisely on that. I mean, what do we do to make sure that we do not, if we regress, we do not regress too much? We produce some kind of sustainability, not necessarily having a positive growth with probability 1, but limiting the probability of a very large loss to a minimum. Okay, so yeah, as you will see, I will also focus on something I believe is important for actuaries, and more for actuaries than for economists and experts in finance. I will focus on extreme events. Okay, something that the economists and asset pricing specialists have overlooked for some time. But over the last 20 years, people like Robert Barrow from Harvard and Marty Weitzman, also from Harvard, have demonstrated that it's really very important to take into account the role of those extreme events. Although those extreme events are very unlikely, they play a very important role in the way we value those actions that generate some positive payoff in those extreme events. Okay, again, you insurer or reinsurer or actuarial scientist, you perfectly understand what I mean here. But for economists, this is still something that is not completely understood and accepted. Okay, so let me take 5 minutes to go back to the basic. How do we value? How do I or we as a community, or we as an economy as a whole, a community of people interacting on markets, how do we value an action that generates some positive or negative benefit in the future? Okay, so, and more generally, I remember I'm particularly interested by the long term, the very long term. So when I decide to invest, or when I decide to invest in a preventive effort to build, stronger buildings to be able to face in next 2 centuries a hurricane or an earthquake. When I do this additional effort to make my infrastructure stronger and more resilient to catastrophes, in general, that is more costly than lighter infrastructure. So it's costly for today. So it forced the current generation to reduce its consumption of consumption goods for those investments. But in exchange, in some state of nature in the future, that will allow future generations get larger consumption, because the infrastructure will still be there in spite of the hurricane or in spite of the earthquake. So how do we value as economists or finance specialists or actuaries? How do we value a project like that, a project that generates some reduction in consumption for the current generation and for some increase or modification in the consumption level in some specific state of nature in the future? How do we do that? Well, let me put ourselves under the video victims. Of course, if I'm the current generation, I'm not happy to be asked to reduce my consumption, to increase investment for the benefits of future generation, and the opposite. If I'm the future generation, I would like the current generation to be forced to increase their investment for my benefits. So of course, because we are in a partiality, we are in a situation of partiality. I'm belonging to the current generation. I consume C0 and I don't want C0 to be reduced because I would be forced to make those investments. So it's hard to make a fair judgment of those investments given the fact that I'm the current generation. And so in that kind of conflict of interest between different people in a given community, here I'm speaking about different generation in the community of all generations who will live on this planet in the coming centuries and millennia. The philosophers have proposed to use the notion of the veil of ignorance. So let us assume that we are under the veil of ignorance about which generation I will belong in the future, when I don't know, so I have to decide about whether it's socially desirable or not to make an investment without knowing whether I will be born in the current generation or whether I will be born in one of the future generations. So this veil of ignorance is important in order to put everyone in a status of impartiality when we examine the social desirability or the intergenerational desirability of an investment project. Okay, so first I make this assumption of the veil of ignorance. Observe that with this veil of ignorance, I transform economic growth, that is inequalities between different generations in terms of consumption level. I transform those intergenerational inequalities coming from growth into risk. If there is growth, I know that if I'm lucky enough to be born in a future generation, I will be able to consume more than if I'm born in the current generation where consumption is currently low, given the positive expectation of growth. So the veil of ignorance transforms all inequalities into risk or uncertainty. And that's good for us, decision theorists under uncertainty, because that allows us to talk about inequalities exactly as we talk about risk. And that allows us to talk about how to behave in the face of inequalities exactly as we do when we think about how to behave in the face of risk. So that's good for us. If on top of that you recognize the plausibility, I would say, of the independence axiom, this independence axiom proposed by von Neumann and Morgenstern in the 1940s, that if you prefer an outcome X to an outcome Y with probability 1, you also prefer X to Y when both events are realized with the same probability P. Okay, so that's this very intuitive notion, the concept of the independence axiom. Let me take it and let me recognize that it's a socially desirable property of any decision process that I could make. And so if you combine this concept of the veil of ignorance with the independence axiom, you can represent this the collective objective of the generation to be under the veil of ignorance, okay, in the limbo. Before different people will be born on this planet in different generations, so in the limbo, before under the veil of ignorance, we will all be happy to select actions that is investment decision, policies to fight climate change, policies to take preventive action to make our infrastructure stronger, to more resilient to earthquake and hurricane. We will be happy to select all actions that maximize this discounted expected utility. So capital U here is the utility function that transforms the level of consumption into a level of utility or happiness or well-being, whatever. Because CT is uncertain, of course, you don't know what will be the GDP per capita in 100 years from now. CT is uncertain. You can put a probability distribution on that. And you need to, in order to estimate from today what will be the level of well-being of the future generation, you will take the expectation from the point of view of time zero today, the expectation of the future utility. And you take the flow, you take the sum of this flow of expected utility, you discount at the rate delta. Delta is the rate of inpatient. I will put it to zero because it's penalizing future generation just because it happened that they are born after me. And so delta positive, as we typically assume in economics, is not a good idea because it's morally unacceptable. It's a kind of racism against the future generation. So the utility function is, of course, increasing. The more generation will consume, the more happy this generation will be. So U is increasing. It's also concave. Okay, the concavity of U is completely key here, as you may know. It's characterized at the same time risk aversion and inequality aversion. You know, under the veil of ignorance, inequality is risk, and so inequality aversion and risk aversion are the same thing. If you the concavity of the utility function means that you are risk averse and at the same time you are inequality averse. You transferring 100 euros from a poor to a wealthy make the sum of the utility decrease by this transfer from the poor to the wealthy because marginal utility is decreasing. So I will represent this inequality aversion or risk aversion by a isoelastic utility function. I mean, a function U of C equals C at the power minus gamma divided by 1 minus gamma. Gamma is the degree of concavity of the utility function. Gamma is positive and measure at the same time inequality aversion and risk aversion. So now let me go to the core, and that's the central equation of the paper. There is no paper. In fact, there is a collection of paper. So here is the core of any standard asset pricing formula in all asset pricing textbook. Okay, so let me consider the possibility to increase CT, take some T, maybe 100 years, and let me contemplate an action that would increase CT by BT, some payoff, some B for benefit, some benefit BT, and maybe BT is uncertain, like an insurance contract. BT may be an insurance contract where B is the indemnity specifically in that happens in T as a function of CT maybe. So let me, so you have this random variable BT, that is the increase in consumption that will happen, that will materialize in T years from now, if you make an action today. And let me try to estimate what's the willingness to pay, what's the value from the point of view of today of generating this gift for generation T. Okay, let me value this by saying it's a present value, PV. Okay, the present value of this future benefit, of this future potentially uncertain benefit. So this present value satisfies this equality. This first equality in this slide tell you that if you pay PV and you receive BT, so if you actually pay this maximum amount you are ready to pay to get BT in 10 years, you will have a level of utility intergenerational inequality, the sum of the utility of the current generation, that rather than getting C0, they get C0 minus the present value they are ready to pay to get BT in the future. So that's the utility under the new system with the investment cost today would be PV. That's the utility of the current generation. The expected utility of the future generation is, of course, unknown because CT and potentially BT are uncertain. So you take the expectation of this utility of this added total utility. You take the discounted sum of the two. This must be equal of what you get in intergenerational utility if you do nothing. Okay, so this equality defines the value of the present value of BT. Okay, and so you assume that BT is small compared to CT, so you can make first order Taylor approximation, and you get that PV is equal to, in the second line here, equal to the expectation of the product of BT, the benefit, maybe uncertain, multiplied by a price, a state price, price kernel, as we say it in asset pricing literature. So, and this price kernel is given by the ratio of marginal utility, potentially multiplying the numerator by the discount factor expectation minus delta T. So if you define RFT at in the last line of this slide, if you define the discount rate RFT by delta plus gamma times GT, where GT is the annualized growth rate of consumption between 0 and T, you see that this PV here can be rewritten at just the expectation of BT times the exponential of minus RFT times T. So you see that the present value is the expectation of the future value BT discounted at this discount rate RFT. But RFT, observe that RFT is itself, this risk-free rate is conditional to GT. So it's conditional to CT. So for each state of nature, for each macro scenario, okay, so how do you compute the present value of BT here? You take each macro scenario defined by CT. So for each potential CT, you derive the annualized growth rate of consumption between 0 and T, given by GT equal 1 over T times the log of CT divided by C0. So that's the annualized growth rate of consumption. And you use it in this, what we call the Ramsey rule, but it's specific to that specific scenario. You need in that scenario to discount the benefit that materializes in that scenario by this state-specific Ramsey rule, delta plus gamma times GT. And so you do that for each scenario. For each scenario, you estimate the benefits you will get. You estimate the discount rate you should use using the Ramsey rule, and you discount this benefit at this discount rate. And that you do that state by state, and then you take the expectation of that, and that's generate the ex ante, without knowing the state of nature that will materialize in 10 years. That's how you value this BT. So here you have a simple formula that allows you to estimate any benefit, any payoff, uncertain payoff, materializing in some future date T. And of course, if you have a flow of benefit rather than specific benefits materializing in specific date, you repeat this for each date where you have a non-zero benefits, and you add up all those present value in order to compute the present value of the flow of uncertain future benefit. So you see, it's a simple methodology. Here I do it just for one specific date, but the idea here is what we call the stochastic discount factor. So the present value, just the future value discounted at some specific discount rate. This discount rate is obtained by the Ramsey rule, and you do that state by state. You estimate this conditional present value state by state, and then you just take the expectation, and that gives you the value of this asset. and this asset being identified by the random variable BT. So let me take the special case, and it's very important to understand the special case, the special case of a risk-free society, a risk-free economy. Okay, so you know, suppose CT is not uncertain. You perfectly know what will be the GDP per capita in 50 years from now, or 100 years from now. So you perfectly know G, the growth rate of consumption between now and in 50 years. Then you, assuming that you know that these two parameters, delta and gamma, remember that delta is the rate of pure preference for the present, the rate at which you penalize future generations just because they are born after you. And gamma, which is this degree of concavity of the utility function, which you remember measure the degree of inequality aversion or risk aversion. But here there is no risk, so it's just inequality aversion. So you see that if you, for example, you assume that delta equals 0 and gamma equals 2, you just use a discount, a risk-free rate, which is just equal to 2, if gamma equals 2, times the growth rate of consumption. So if you assume that the growth rate will be forever 2%, you should use a discount rate of 4%. Why do we do that? What's the intuition for why we penalize future benefits just because they materialize in the future rather than today? Well, the intuition is very simple. It's explained in this second bullet point. Well, in a growing economy, future generation will be wealthier than us. Okay, that's right. So transferring, so we face, under the veil of ignorance, we face inequalities. Future generations are luckier than us. Okay, they will enjoy larger consumption. Because we are inequality averse, observe that investing is problematic because investing requires the current generation to sacrifice some of your income of the poor to increase the income of future generation who will be wealthier. Okay, so in a growing economy, investing has this very negative impact on intergenerational well-being because it will increase, not reduce, it will increase intergenerational inequalities. It will make future generation wealthier and current generation poorer. We would like to do the opposite under inequality aversion. In a growing economy, we would like future generation to transfer income to us. Okay, so I hope you understand and agree that in a growing economy, investing has this bad negative effect on intergenerational welfare, that because it increases intergenerational inequalities. That does not mean that you necessarily dislike the investment. If the investment has a return that is large enough, the effect on prosperity of that investment with a positive return may be large, will have a positive impact on intergenerational welfare, and therefore you have a balance here between increased prosperity and increase in inequalities. Okay, depending upon your degree of inequality aversion, you will prefer prosperity or reduction of inequalities. So in one sentence, you have it in this second small bullet point. In a growing economy, the discount rate, the risk-free discount rate, I mean, is the minimum internal rate of return of a risk-free project that compensates for the welfare deterioration of the fact that investing generates increasing inequalities. Okay. So that's the main reason why in economics, of course, you have arguments by arbitrage, and if you have a risk-free interest rate in the economy, of course, that's also reflects the cost of capital for a corporation, and of course, you should not invest in a project in that corporation if you if the return of the project is smaller than the cost of capital. That's obvious, but that does not answer the question of why the cost of capital is positive. Okay, why the interest rate is positive. Here you have an answer to that basic question. The interest rate is positive in a growing economy because in that situation, investing for the future increase inequalities, and you are not happy with that. And so you need to have investment project to find that investment is socially desirable. You need that those investments have a large return enough to compensate for this negative impact on welfare. And of course, the larger the expectation of the growth, the larger the interest rate. So these days, interest rates are growing. Some people believe that the growing interest rate in the world comes from the fact that artificial intelligence will increase the prosperity in the future, will increase G, will increase growth, and therefore there will be more intergenerational inequalities, and that implies that you need to have a larger interest rate to force reducing investment, because in that society, again, with the growing larger growth rate, the effect of investment is even worse in terms of intergenerational inequalities. So that's the main idea. So keep in mind that this Ramsey rule crystallize or translate in mathematical terms this simple intuition that in a growing economy, you need to have a positive interest rate to compensate for the fact that risk-free investment increase intergenerational inequality. You see indeed that the Ramsey rule they give you an interest rate, a risk-free interest rate, which is growing with G, the growth rate of the economy. So that's, you get exactly this intuition. And so you have this intuition now for the risk-free rate. In the case of an uncertain growth rate, well, this previous slide just reminds you that you should do exactly the same thing. The same argument must be applied state by state. State by state, you look at how you would value your project, assuming you know this growth rate. You use the Ramsey rule with this growth rate that give you the discount rate at which you need to discount the benefits in that state of nature. You do that state by state, and you take the expectation of that. That's the value of that uncertain asset that give you this random variable BT in the future. So this stochastic discount factor mechanism is a simple provide a simple method to generalize this Ramsey argument in the case of uncertainty. And in fact, all textbooks in asset pricing start with this simple insight. Okay, so now let me try to do an experiment with you. I will not formally do the experiment, but I would like you to think about the following exercise. And this exercise is an exercise that has been proposed by Arthur O'Kuhn in the 70s. And the exercise corresponds to what we call the leaky bucket experiment. Okay, suppose that you are a social planner, you are the government, you have to determine whether we will reduce inequalities or not through some specific policy. And suppose that we just live us in a situation where the transfer of income will go from X to Y or from Y to X. And let me assume that X is wealthier than Y. So X consumes twice as much than what Y consumes. And the question is the following. The question is, we are going to transfer some amount of consumption from X, the wealthy, to Y, the poor. But in between, the problem is when you take money from the wealthy, some of it disappears. Okay, the pipeline is leaky. Some of the money you take from one's pocket you get only some of it, a part of it, when you get out of the pipeline to give it to the poorer person. Well, you give me a story associated to that, moral hazard problem associated to taxation of the most productive people in this society. You tell me. Fiscal exile of the billionaire if you put a Zuckman tax, whatever. So suppose that to get you suppose that you take €1 from the wealthy. What's the minimum amount you need to give to the poor that make this transfer socially desirable in spite of the leak? Okay, so let me give you an example. Suppose that in the system, so suppose that, remember, X consumes twice as much as Y. Okay, suppose that I take €1 from the wealthy, that I can only give 10 cents to Y. 90% of the money disappear in the process of the transfer. Would you find it proposal, the policy, desirable or not? Under the veil of ignorance, of course. I don't tell you whether you are X or Y. So I take €1 from the wealthy, I give 10 cents to the poor, and 90 cents are lost. Do you like it or not? Well, I think that most of us will say, okay, that's reducing inequalities, but the lost prosperity is totally unacceptable. So we don't want that. So let me increase the amount of money that I will give to the poor, and let me check at which level of this transfer to Y you will find this project socially desirable or not. So let me assume that the minimum amount of money to give to Y that compensates for taking 1 from X is 25 cents. So suppose that you are just indifferent to a policy in which I extract €1 from the wealthy and I give 25 cents to the poor. And that's a situation where my preference for reducing inequality is just compensated by the lost prosperity. I mean, you see in this system, I lose 75 cents of GDP in this process. But the fact that the policy reduces inequalities make it desirable. Okay. Let me assume we agree on that. Many of you may disagree, and we may have a discussion on that later on, but let me assume we agree on that. Let me tell you how this experiment is helpful to determine the discount rate that you should use for some specific time horizon. For example, suppose that I live in a society where we all agree that consumption will double within the next 35 years. Okay? And so suppose that generation X will live in 35 years, generation Y is the current generation, and let me ask you, what's the present value today of a benefits of €1 in 35 years? Well, you know what? That's exactly the same question, except that in the first part of this slide, I ask you a question. Of course, it's a temporal question, whereas in the first bullet point, it was an atemporal question, but it's the same issue. What's the value today? What's the maximum amount you are ready to sacrifice today to give €1 in 35 years, where people there will consume twice as much as what we do today? That's the assumption. Okay, well, that's 25 cents. Okay, so the present value, if we agree on this first part of the slide, you should agree that the present value of €1 in 35 years is 25 cents. And in fact, saying that is equivalent to say that you use a discount rate of 4%, because indeed you can check that by yourself. What's the present value of a sure benefit of 1 in 35 years when you use a discount rate of 4%? that's 25 cents. Okay, so you see here, I make absolutely no reference to any model or social welfare function or whatever. I just ask you, how do you value a transfer from a wealthy to a poor? And that's given me enough information to infer what discount rate we should use in that economy if I assume some specific growth rate of consumption. So in fact, in mathematical terms, you can check that being indifferent to a policy that take one from the wealthy to give 25 cents to the poor is equivalent to imposing a degree of concavity of the utility function gamma inequality aversion equal to. You can check that by yourself. You can also make the computation by yourself that consumption doubling every 35 years is equivalent to a growth rate of consumption of 2%. And you can indeed check that the Ramsey rule is correct here because the 4% of the discount rate is just equal to the product of gamma equal to by G equal 2%, and 2 times 2% is indeed 4%. So you see here, I gave you a model-free Ramsey rule. And again, my pedagogical objective here was to again focus on this basic intuition that why we discount the future, because we are inequality averse and in a growing economy, inequalities. Yes?
There is a question from George John, maybe a technical question, of course, not a question of substance, but probably a question of understanding. Maybe I let you judge if you, okay.
Okay, George.
My question is, do you understand?
Yeah, there is an echo, but I think I can follow you.
Okay. In the second part of your example, X and Y do not have the same age.
Yeah. X living 35 years from now.
Yeah, so this is not only a transfer from the poor, from the rich to the poor.
Correct. It's the poor. I associate poor, if you want, poorness with current generation and wealthness with future generation. I'm sure it's not Englishly correct, but yeah, that's the point. But again, under the veil of ignorance, remember the arguments of the veil of ignorance, George. I would like us to determine what should we do, what's our moral obligation today towards future generation. How can you answer that question in the partiality context we live, because we know that we are the current generation, in order to determine what's our social, what's our moral liabilities, what our moral responsibility toward future generation. I put myself under the veil of ignorance, where everyone is there, not knowing in which generation he or she will belong, and we have to make a decision. How much are we ready to sacrifice from the current generation to give more to the future generation? So here you see, under the veil of ignorance, the notion of age disappears completely. Only inequalities matter. Okay. Okay, so you know what? Because of the Zekman tax in France, I wanted, but also for other reasons associated to the well, it's probably true in most countries around the world these days. But I'm fascinated to see that this Ramsey rule, you can calibrate the growth rate of consumption, but probably with some uncertainty. But that will be taken into account with the stochastic discount factor approach that I presented earlier. But I'm fascinated to see that there is very little discussion and estimation efforts in my profession about estimating the gamma, the degree of inequality aversion. Okay, and so you see, in fact, in this exercise on this slide, this is exactly what I tried to do. I tried to estimate what's the minimum amount to give to the poor that compensate for taking €1 from the wealthy. In asking that question, I'm trying to estimate your degree of inequality aversion. So we did with colleagues, Karin van der Straten from TSC and Jacques Zang from Aix-Marseille School of Economics. We raised a questionnaire for mostly 3,000 French respondents, representative of the French population. We were able to use 56 of those data, and we exactly raised that kind of question. What's the maximum amount? What's the minimum amount you need to give to the poor to compensate for a loss of 1 from the wealthy? Well, in that experiment, we do we do it in that direction. We also do that in the opposite direction. But asking you that suppose that I take money from the poor to give to the wealthy. You give €1,000 to the wealthy. What's the maximum amount you are ready to sacrifice from the poor to give €1,000 from the wealthy? Of course, these two questions, the leaky bucket experiment that I presented in the previous slide, and this symmetric experiment should give you the same number, but you can imagine that in reality, people have some kind of a taboo against taking money from the poor and generate a much larger degree of inequality. So that's the hypothesis we make in that paper, and indeed we show that people are much more inequality averse when we take money from the poor to give to the wealthy, and rather than the opposite. So anyway, if you are interested, I could do another webinar on this specific question, but keep in mind that in the literature, the economic experts that have been using the Ramsey rule and calibrating the Ramsey rule typically use a gamma equal 2 or around 2. Some use smaller numbers, some use larger numbers, but the median calibration of gamma was around 2. So meaning that if you reject any idea of racism against future generation, you take delta equals 0. I take gamma equal 2 as my reference calibration of the Ramsey rule in the risk-free world to estimate the risk-free discount rate, or in the stochastic discount factor model to estimate the stochastic discount rate. So I take gamma equal 2, so meaning that indeed this is you won't swear that the minimum amount of money you need to give to the poor when you extract €1 from the wealthy is 25 cents, assuming that the wealthy consume twice as much as the poor. That's my moral attitude. That's my estimation of our degree of inequality aversion. But again, you may disagree, and I'm almost sure that Gabriel Zuckman, for example, has a degree of inequality aversion which is much larger than mine. And therefore, I justify that taking a lot of money from the wealthy, even if most of those wealthy persons will leave the country. Okay. So let me
just Christian, a question. Yes. When you said that, in fact, you have confirmed your 2% with a survey. Of course, it's not the big survey or all French person, but at least 2,500 person respondents. When, for example, you say, okay, Zuckman has probably a higher gamma than 2, but behind this risk aversion, it's a subjective one, a personal one, not drawn from any survey, to my knowledge. But is it correct?
Yeah, excellent question, Philippe. So my gamma equal 2 has been the number I've been using for over the last 30 years in my research. And that's because my calibration is based on observation of behavior under uncertainty. Remember that under the veil of ignorance, attitude toward risk and attitude toward inequalities are exactly the same things. And so we can observe how people behave in the face of risk. And that gives me their degree of inequality aversion. And gamma equal 2 is indeed quite of a consensual degree of risk aversion in the literature on behavior under risk. But indeed, in the experiment, we get in particular when we do the experiment opposite to the leaky bucket. When leaky bucket, remember, is I take money from the wealthy to give to the poor. The opposite is I take money from the poor to give to the rich. In that case, I observe much more degree of inequality aversion. So a gamma more larger than 2, I get 2.56, which is sizably larger than 2. You can look at the impact of that change and discount rate. That's not marginal. So my gamma equal 2 is rather coming from, not from experiment on actually degree of inequality aversion in the kind of experiment that I just presented, but it's coming from the notion of the veil of ignorance. Risk aversion, inequality aversion are the same thing, and I have quite good estimation of degree of risk aversion, and that's what I use. Philippe, are you okay with my answer?
I assume yes. No, I am okay.
Okay,
thank you so much, Christian.
Thank you.
Maybe if you can slightly accelerate, I think we will not be able to fully cover your presentation. Maybe if you would agree, we could organize a complementary webinar, so as to be sure we end up, depending on, of course, the feedback we will get from this first seminar. Just
perfect.
I close here my intervention.
I usually put much more slide that I know what I'm able to cover. The first and with the idea to put the most important at the beginning to be sure I cover that. Yes, if you give me 10 minutes, I would like to talk about how to extend this to the case of uncertainty in particular. I would like to give you a few insight on the importance of taking care of fat tails on the importance of the tails of the distribution when we value uncertain payoff, even certain payoff, risk-free payoff, I mean. So in order to do this, I wrote a paper that has been published in the Geneva Review, Risk and Insurance Review, I'm sorry, 2 years ago, I think. And so the one application of this paper is the following. So suppose that I can represent the uncertainty about the future with the Brownian motion. I know Brownian motion is not a realistic representation of the future. In particular, it has thin tail, and there is no extreme. The probability of extreme events is extremely small. However, let me take this assumption for pedagogical reason. So let me, because it's quite easy to compute the solution of that. So let me assume that CT follows a geometric Brownian motion with a trend of growth of 2% and a volatility of 3%. 2%, 3%. These things are extracted so typically of estimation of GDP growth in the Western world over the last century. So consider a sure benefit. Suppose, so let T be free. I will compare different time horizons. So let me assume I compare, I look at different investment projects with a fixed maturity. It's a zero coupon bond, in fact. It's a zero coupon bond that generate a single coupon at dt, and let me assume that this coupon is just given by this number. Okay, it's a number. There is no uncertainty there, so it's a sure payoff. And in fact, it happened that this zero coupon bond that generate this single payoff at dt. This zero coupon bond has a value today of 1. Why? Because if I go back to my pricing formula here, if BT is just equal to the inverse of the expectation of the exponential of minus RFT, the expectation of this will be 1. Okay, obviously you see that here. Okay, this is a random number because GT is uncertain. Remember, GT is the annualized growth rate of consumption. Okay, in a Brownian motion, it's a random number. In fact, it's normally distributed. Okay, but the expectation of this is equal to 1, obviously. Okay, so all those coupon bonds, when I will compare them, have one common property. They have all a present value, a market value, if you prefer, of 1. Everybody agree on this? Thank you very much. So let me see from this unit valuation of those different coupon bonds, zero coupon bond, where come this value from? Okay, remember the value of this coupon is the expectation of their conditional present value. And that's exactly what I said earlier. We need state by state to estimate the present value using the Ramsey rule associated to that state of the world, given the growth rate in that state of nature. You discount at that discount rate the future benefit, and that gives you the conditional present value. So, and the value ex ante, just the expectation of that. So let us look at the distribution of those future value whose I know expectation is equal to 1. So this is this table. I do it for a zero coupon bond maturing in 10 years, in 30 years, or in 50 years. And well, you see what all those distribution of the conditional present value, all those density function have a unit expectation. Okay, they all have the same unit expectation. They all have a present value. All those coupon bonds have a present value of 1. Okay, their conditional valuation have an expectation of 1. But you see the picture here. When I look at longer maturities, longer and longer maturity, in fact, you see that the probability that the conditional present value will be smaller than 1 becomes larger and larger. And in fact, the probability that it's smaller than the mean 1 tends to 1. It's almost, and in fact, you see when I could have drawn the other maturities, you see that in fact, this density function, this random variable PV star t, the conditional present value, tends to 0 almost surely when t tends to infinity, although it goes to 0 almost certain, almost certainly, in spite of the fact that the mean is equal to 1. What does that mean? It means that the value for very long maturities, risk-free payoff, generate most, if not all, their value from the fact that we value a lot that this zero coupon bond will generate a positive payoff in the catastrophic state of nature where CT tends to 0, where we go back to Stone Age. So that's a very strong message. Okay, although Brownian motion have thin tails, okay, it happened that the way we value zero coupon bond in that kind of economy for very long maturities, okay, we almost always regret investing in zero coupon bond. Almost with certainty, almost surely the value of this coupon bond conditional to the state of nature will be 0. But we still are ready to value that with the value of 1 because of the very, 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 very unlikely scenario where we go back to Stone Age, where the consuming the payoff of the zero coupon bond save humanity. Okay, so let me stop here. just to focus, I mean, again, if you maybe just one more slide that complement this. But here, keep in mind the very bizarre things happen for very long maturities. For very long maturities, where sustainability question becomes very important. In fact, critical. I mean, this slide tell you that really the way we value risk-free asset like a zero coupon bond maturing in the very distant future, it gets the valuation of this asset is very bizarre because most of its value ex ante come from the fact that you value it a lot in the extreme event where you go back to Stone Age. Of course, it's even worse, it's even stronger for insurance assets, insurance policies, where you generate a payoff only if you go back to Stone Age. Of course, this is even stronger, where you put no value to that asset in any other assets, any other state of nature than that one. So, and keep in mind that in spite of the fact that you value things in the very long run, specifically focused on extreme event, keep in mind that under this assumption of a geometric Brownian motion, this in this framework, you can replace this approach using the stochastic discount factor by the alternative approach of the consumption-based capital asset pricing model, where rather than discounting state by state and taking the expectation of that, you are going to discount the expected benefit at risk-adjusted discount rate RT. So that's an alternative approach under the assumption of a geometric Brownian motion. Okay, under this assumption, you can substitute the stochastic discount factor approach by a CCAPM approach, where you are going to discount the expected benefit at a risk-adjusted discount rate, and this risk-adjusted discount rate is given by the risk-free rate, RF, adjusted for the risk, when the risk is given by beta. Beta is the elasticity of the benefit to change in aggregate consumption, as given by this equation log of BT equal AT plus beta log of CT plus epsilon. So the beta is a measure of riskiness or correlation of the benefits to the macroeconomy. And so when beta equals 0, you will discount the expected benefit at the risk-free rate. But when beta is positive or negative, you will adjust upward or downward this risk-free rate to the riskiness of the project by adding this beta times pi, where pi is the aggregate risk premium. And so you see that this formula of the CTAPM is interesting because nothing happened for very long maturity. For very long maturity, you are still discounting at the same discount rate adjusted for risk. But keep in mind that again, for the risk-free rate, but also for risky asset, most of this valuation comes from what happened in the extreme event. Okay, let me conclude. We observe that for the risk-free rate, you get here the standard Ramsey rule, RF equal delta plus gamma times G. Here, G is replaced by the expected value of G mu. But you are going, because of the riskiness of the macroeconomy, the riskiness of GDP per capita, you are going to reduce the risk-free rate by some precautionary term here, which are, you reduce by a positive number. And that reflects the idea that under uncertainty, you want to do more for the future than without uncertainty. And how do we value more the future? How do we do more for the future? We reduce the risk-free rate. Okay, so that's specifically for risk-free asset, but of course for risky asset, when beta is not 0, you need to add or subtract by beta time pi. Okay, so let me finish by providing some references, and I'm done. Thank you very much, Philippe.
Thank you so much, Christian. I will be just very short, perhaps not asking question because we have a question which has been raised by one of the auditor, but just because you are referring to the references, are there which of these references you would recommend to put on a website with your presentation, maybe in order to explain? Do you think that Charbonnier, Gaulier, and Pomeroy, and Gaulier, van der Straten, and Zeng should be the best?
No, I'm sorry. This is selfish, but put my single author paper published in Geneva Risk and Insurance Review 2024. This is the one where I explain this idea that for
and the role of
maturity,
the
extreme scenario are the driving force for the pricing of assets.
Okay. Maybe if you can share with us, because at least the working paper, which will be great, so that people just looking at the presentation may also, if they have further question and want more insights, to look at your paper. Just I have here at least one question from Isabelle Prolion. Maybe Isabelle, if you are connected, you could raise by yourself the question better than myself reading your question, if you would agree.
Yes, of course. Bonjour, Philippe.
Bonjour.
Alors, thank you, Christian, very much for the presentation. I was wondering, it's not directly connected, but I was wondering if you have also been working on what would be the impact of stable coins and the ongoing current policy in the United States of these aspects into the debt and equilibrium in currencies. And then how to take geographical specific exposure into account. And if you know if there is some research on this approach, because I am wondering I have been wondering for a few months this kind of subject for actuaries, and it might change the notion of veil of ignorance within the same country. I mean, when we look the homeowners, or I don't know, the equilibrium in ILM, this would be in scenarios a big well, at least we can build different scenarios here, or maybe not, I don't know.
Thank you very much.
Thank you.
Thank you for the question. Okay, asset liability management require that you have the same beta of the estimation of the riskiness of the asset and the riskiness of the liability. So you will eliminate the sensitivity of your net position of your corporation to change in the economic macroeconomic growth by taking assets that have the same beta than your liability. So then the question of how do you estimate the beta of your asset? So you are talking specifically on the stable coin. I have absolutely no idea. Well, I have some feeling about what's the beta of an investment in bitcoins. Obviously, have that on my computer every morning. So I see that when there is a recession, the Bitcoins are down on average, and when there is an expansion, the Bitcoins are up. Well, or not. In fact, I'm not completely sure. Maybe Bitcoins or stable coins behave like gold. Remember, gold typically is a negative beta asset. It's an asset that whose value goes up when there is a war or when there is a pandemic. And so a negative beta asset is nice because it provides an insurance for people who have a hard time to insure against a stagnation or a recession in the country where they live. So yeah, I cannot answer your question because I don't know the sign of the beta of the asset stablecoin. I'm almost sure that an estimation of beta like for that class of asset must exist in the literature, but I'm sorry, I'm not a specialist on
thank you.
Normally
therefore, maybe Christian, in fact, when looking at your formula, the uncertainty is of secondary order, in fact, because you are taking the square of the volatility. That is it only matters if you are confronted with a big risky GDP, for example, in case of civil wars or so on, and of course concerning either the Bitcoin or the stable coin, the question is the volatility, which is absolutely huge concerning the Bitcoin, therefore a dramatic risk. And for stable coins, you have also, and we don't know it, but probably a huge credit risk. But in fact, this is having an effect if the risk is sufficiently large and big, which is what you have been insisting on.
Yes, yeah, thank you. Both comments are great and important. Yeah, in fact, one of the things that I didn't cover is that, for long maturities, so you start with your point, Philippe, that risk does not matter a lot because sigma is small and sigma squared is even smaller than that. And therefore, the risk-free rate is not so much impacted by the uncertainty we face for long maturities. In fact, although in spite of what I said about extreme events, geometric Brownian motion future log consumption is normally distributed, obviously, and so these imply thin tail. So geometric Brownian motion cannot explain the recession, the 2008 recession, cannot explain the Great Recession, the Great Depression. It cannot explain the two world wars. It cannot explain the Greek crisis in Greece 15 years ago. So in fact, geometric Brownian motion is not very realistic representation of the future. In particular, it's not a good representation of our uncertainty we face for the very distant future. For example, how do you calibrate the trend of growth for the next millennium in France or in the world? This is a now. Even if we believe in the geometric Brownian motion, it's based on the trend we don't know its value. And remember, the economic growth where indeed the geometric Brownian motion could be a good representation is very limited to the last century. If you go back to the last 3 millennia, obviously a trend of 2% is definitely not what happened between Nabucodonosor and the French Revolution.
Maybe a closing economy confronted with civil wars, etc., may provide better example, which we have been seeing also in the past, of very, very extreme event on consumption and collapse of consumption.
Well, you are partly right. I mean, I recommend you go to Robert Barrault paper in Quarterly Journal of Economics. It's either 2006 or 2009. It's collected in the Madison data. He collected in the Madison data all events where GDP per capita of different countries went down by more than 25% within 2 or 3 years. And of course, you get there a lot of events related to war, civil war, but also depression and financial crash. So it's diverse nature, and who know how the 21st century will look like in terms of the origin of the crashes and macro catastrophes that we will face in the coming century. I don't know.
Yes, maybe let me ask if there are questions otherwise by other persons. I don't see your hand be raised. Is it true? No hand raised? Oh,
George,
George, you have a question. Sorry. Please.
Can it be that the model underestimate the very low probability events?
Okay, I like the question. In fact, implicitly, you are asking me, do we know the low probabilities of the low probability event? Of course, the answer is no. So I have a paper that I published in Journal of Monetary Economics in 2017, where I look at, for example, a Poisson process where you have with the low probability catastrophe that may happen. It's an IID process, but you don't know the true probability of the Poisson event. And indeed, not knowing, so the Poisson process, possibility of infrequent catastrophes is an important element to value assets, and Robert Barrault was very clear in explaining that in his 2 papers of the decade 2000, 2006, and 2009. But he assumed we know the probability of catastrophes. He assumed a probability of catastrophe every year in the US of 1.7% per year. So he assumed that with the probability of 1.7% every year, the US economy will face a catastrophe where the GDP will drop by more than 25%. Of course, this probability of 1.7% comes from computation from the data I just mentioned, but it's not known. It's clearly not known. And in my Journal of Monetary Economic paper, I show that introducing some uncertainty on this probability of infrequent event has a deep impact on the way we value assets. So your question is perfectly important, and indeed introducing uncertainty on probabilities, and more generally introducing parameter uncertainty or model uncertainty in the way we price things is crucially important.
Thank you.
Maybe we will have to close, Christian, but I have just, it's not really a question, but what kind of recommendation would you give to current actuaries when confronted with long-term liabilities today? Just continue to stick to sovereign interest rates as per the most advanced economies and maybe the least insecure sovereign bonds? Or do you think that we really have to think twice and probably develop other alternative solution, which of course will be also a recommendation we will have to make to regulators and supervisors?
Well, I think it's important to have in mind that there is a correlation between the future interest rate and the future prosperity of the economy. And so you have to have a look at that's asset liability management. The interest rate you will have to use is a function of the prosperity of the economy, and this prosperity will affect the value of your liabilities and the value of your assets. So this, for the very long run, in spite of the fact that for short maturities, of course, the interest rate is stochastic and comes from monetary policy of the central bank. In the long term, the main driver of the interest rate is the prosperity of the economy. So that's a fundamental insight of the Ramsey rule, and I think it's a strong insight. It has been demonstrated several times in the literature that this Ramsey rule is very relevant for long maturities. Of course, again, the central bank can manipulate short-term interest rate, but it's much more difficult for long maturities. We know that, and the long maturity interest rate is driven by expectation about the growth rate of the economy in the future. So you need to anticipate the scenario where in 20 or 30 years from now, we may revise downward our expectation about the growth of the French or European economy, and that will negatively affect the interest rate on your assets. Okay, and those things need to be taken into account. So going back to the basic economics fundamentals of what drive the long-term interest rate is something that I think the actuaries should keep in mind.
Okay, and therefore we should also at the same time look at the beta concerning the specific risk we are valuing.
Exactly.
Okay.
Exactly.
I think, please, with this last recommendation, thank you so much, Christian. I think we should regret to have to close the webinar, because I think there are a lot more to present on your side, and a lot more probably questions and things to discuss. Let me look if there if some interest is expressed in developing further what you have presented, and then we will turn back to you if you agree, of course.
Sure.
And but I would like to thank you so much, because it was a very, very insightful presentation and stimulating presentation. Of course, it is not so comfortable for our current business, because we have to it's a challenge to see how to adapt our valuation of the very long-term liabilities and asset. But thank you so much, Christian. It was very, very highly interesting, stimulating, and innovative.
My pleasure, Philippe. Bye-bye.
Bye-bye, and bye-bye to all of the persons who have been connecting and listening until now. Goodbye. Oh, Zéline, je ne sais pas ce que tu en penses. Faudra voir peut-être, parce qu'il n'a pas